Well, California Governor Jerry Brown says that he is considering delaying or reducing plans for an $11 billion bond proposal, saying the time is just not right for a big bond issue. But this year has seen some of the best investor returns for muni bonds since 2009. Joining us now for more is BlackRock Senior Portfolio Manager and Managing Director Peter Hayes. BlackRock, by the way, oversees more than $102 billion worth of muni bond assets. Great to see you back here, Peter.
Great to be here. Good morning.
Let me just focus in on this California issue first off. I mean, you know, when you hear the governor say, look, the time's just not right for big bond issues, you think he's talking mostly about California, or is that a situation for a lot of these states around the country?
I think that's an interesting question. We had this discussion yesterday, and we're kind of looking at where issuance will be next year because it's had a big impact on the market this year. And we use California as an example, and we're wondering if this aversion to taking on debt in an era of fiscal austerity is also going to take hold in other parts of the nation. And our guess is yes. I think it's getting harder and harder for them to justify very large debt issues when the rest of the economy is essentially deleveraging. So you're seeing some of this deleveraging in the public sector as well. So yes, I think it is indicative of what's going on in the rest of the country.
So bond issues in what range will likely get done next year, and what won't get done next year?
I think it's also a matter of they look at their needs. It's what do they really need to borrow for versus what would they like to borrow for. And I think they have to focus on what they need to borrow for and put aside what they would like to borrow for
in
down
California,
the road.
it's for I think refurbishing their water system or something like that.
Correct.
Yeah.
So I think what they're going to do is a lot of these projects you're going to see get put off for a number of years until the economic environment improves. So as a result, these bond deals, which might be 11 billion or 8 billion or 9 billion, get downsized. I think that's probably the trend that we think we'll see over the next few years.
And what will that mean for investors then of muni bonds?
That will mean less bonds to buy in an era where they're searching for income. So it's going to get harder and harder to find the right bond, especially in the high quality part of the spectrum like state GOs and essential service revenue bonds.
Okay, and does that mean returns will be more moderate than what we saw in this year?
Oh, they should be. It'd be very difficult to repeat what happened this year. You mentioned 2009. That was a correction from the dislocation in 2008, and this year was somewhat of a correction from the dislocation in the fourth quarter
I think
of last year.
Muni bonds returned like 11% or something like that?
That's right, just under 11%, and some products even more robust returns. But a lot of that was a fall in interest rates, and it's going to be very difficult unless there's very large systemic problems in globally or the U.S. economy.
Right.
It's going to be very hard to get interest rates lower from here. So it's going to be more about picking the right bond for income, less about price appreciation in 2012.
Well, your best guess or prediction in 2012 for the returns, I mean, if we're not going to get 11% next year, what will it likely be then for investors?
I think you have to look at what the average coupon is on a lot of these A-rated and AA credits, and somewhere in the 4% range I think is probably a more realistic return. But keep in mind too, that's also a pre-tax return. You have to add in the tax benefit, which becomes even higher. Right,
which obviously is a big attraction for investors. Right. Now, also this year we've seen a lot of flows, right? A lot of money flowing into funds like yours, who want to take advantage of the returns. I mean, is that flow going to dissipate then, or slow down because those returns might not be as high?
We think the flows actually might even pick up. It's been a complete reversal in terms of fund flows this year. At the beginning of the year, it was 29 straight weeks of outflows because of some of the predictions from last year. All that was going on. And this year we've seen over the last 11 or 12 weeks, we've seen inflows, pretty robust inflows, averaging about 600 or 700 million on a 4-week moving average. But it's a search for income, and that's why people buy municipals, because they get to keep more of what they earn because of the tax benefit. And so we think that trend continues. There's still a lot of value, and there's been less volatility in municipals than in other asset classes, whether it be equities or even U.S. Treasuries.
Right before the break, you were talking about fund outflows in the beginning of this year, right? A lot of that driven by the fear of bankruptcies or some of the bankruptcies that were reported. We had Jefferson County, I think.
That's right.
Harrisburg as well. Will that have been the worst of it in terms of bankruptcy filings, do you think?
I think those were two of certainly the bigger ones in terms of being in the market every day. Those are two that we worried about, not because necessarily of them being indicative of the rest of the market, really because of the headline and the fear factor. Would that raise people's awareness, lead to more fund outflows again? So Harrisburg, essentially, Pennsylvania has taken additional steps to prevent bankruptcy filings in the state of Pennsylvania. So that went to court, and the bankruptcy actually was thrown out. So they don't have the ability to file bankruptcy legally, and the state will intervene and help restructure some of the debt and also make some pretty fiscal some pretty tough fiscal decisions, I think. In the case of Jefferson County, that's a little bit different. That's a very big one. It involves very complicated. It involves a very large deal that involved a lot of corruption, a lot of fraud. It was a completely outsized deal if you think about a sewer system in rural Alabama. So that's going to be interesting to see the outcome of that one. But again, that's going to take, I think, some time to work its way through the courts. But the good news is the actual headline is behind us.
Right, and the fact that it's a unique situation may be some comfort to investors, because then it's not a typical case where, you know, it might be the first of several other types of similar bankruptcies. But getting back to California and also to Illinois even, because the two states actually, I think, have the lowest credit ratings right now by the rating agencies. And I wonder, since they got that this year, you know, how far are they from an actual upgrade now?
It's hard to say how far they'll upgrade. Usually what the rating agencies will do is they'll put them on outlook positive so that things look better, and then over some period of time they'll evaluate, and if the trend does continue, then they'll upgrade. I think Illinois probably has a deeper hole. They've had a more difficult time enacting tax cuts. Their budget just structurally isn't, I think, as sound, and their economy as diverse as California, and they have a bigger pension problem. So I think that they might be further down the road. California, on the other hand, I think we need to see if the economy maintains its momentum this year. I think employment growth has been very strong, especially in Silicon Valley in terms of tech.
We've got all those IPOs coming up.
Right, yeah, which actually helps tax revenues also, that's right.
Yeah.
So all that helps the California economy. They've put in better structural protections into their budget in terms of if they don't meet certain revenue projections, automatic spending triggers go into effect. And I think one of the reasons their rating is so low is because politically they were somewhat dysfunctional. I think the rating agencies were penalizing them for a very difficult budget process in the past. That's improved. So if the economy remains firm, it's conceivable that later this year we could see an upgrade in the state of California.
You mean later next year?
Later in 2012.
Later in 2012, we could see an upgrade in California.
Correct. Yeah.
That would be a huge deal then. All right, Peter, thank you. Great to see you again.
Great to be here. Thanks for having me.
Peter Hayes of BlackRock. And